Every well-known consumer brand has a formula for success. But behind the scenes, giving life to these brands, is a company that has perfected the formula for sustainable growth. This is D&L Industries, the largest specialty chemicals manufacturer in the Philippines and exporter to the Asia-Pacific region. We, Venus Investment Research, issue a buy recommendation. Using DCF analysis, we arrive at our target price of 13.30 pesos, presenting 15% upside. So why buy on D&L? 1. D&L has a favorable industry position that fuels steady domestic gains. 2. It has an international growth strategy backed by R&D expertise. And 3. It has a strong ability to deliver long-run profitability. But first, who is D&L? D&L is the leading local supplier for food ingredients, oleochemicals, plastics, and aerosols. Versus the competition, it is the only integrated chemicals manufacturer in the country, boasting the longest operational history of 55 years.
So let's start with our first point. D&L has a favorable industry position that fuels steady domestic gains. As a B2B company, D&L is in the back end of the value chain, where it has an integral role to different front-end industries. The company's products are key inputs in making popular consumer items, fast food chicken, ice cream, and soap, to name a few. You'd be surprised that many of the items you consume on a daily basis can actually be traced back to D&L. And because of its strong link in the product value chain, D&L has broad exposure to resilient expenditure categories which make up almost 70% of the consumer basket. This makes D&L cross-sectionally entrenched in domestic consumption growth, giving it a strong industry position. Cementing this solid position is D&L's shift from commoditized to specialized products, tailor-fit the client needs. For D&L, these products have much higher margins and lower threat of substitutes. And for D&L's clients, these products create added value, giving rise to signature offerings growing faster than other menu items. We expect high-margin specialized products to grow from 63% to 71% of sales, driving a gross margin expansion of 350 bips. Finally, D&L has developed long-standing relationships with large industry players who have strong brand equity and wide sales channels. For QSRs alone, D&L's clients account for 80% of the industry. This proven track record makes D&L the top choice for multinationals who are looking to localize their supply chain. So with its integral back-end position boosted by a shift to specialized products and long-standing relationships, we expect D&L to deliver a steady 10% growth for its domestic sales.
This leads us to our second point. Complementing D&L's domestic gains is its international growth strategy, in line with its long-term goal of growing exports to 50% of sales. The potential of exports can be seen in its increase from 13 to 25% of sales in just 5 years, even with strong growth locally. And now, D&L is expanding to a $361 billion Asia-Pacific specialty chemicals market. So how exactly will D&L achieve this? D&L boasts a solid competitive edge in R&D, with an R&D to sales ratio double the average of regional manufacturers. In an industry characterized by increasing demand for client-specific specialized products, innovation is key to remaining competitive. This is where D&L's R&D comes in, as it has supported the development of over 650 custom formulations that drive more than 70% of its exports. D&L's strength in R&D has also allowed them to secure key foreign partnerships. Its flagship partnership with global food giant Ventura made D&L the supplier of custom ingredients for global brands Burger King, Subway, and A&W in China, Hong Kong, and Indonesia. In just 2 years, the partnership already added 2 billion pesos to revenues, with D&L present in only 4 of Ventura's markets. We expect the Ventura partnership to continue posting gains as it covers the entire region. And supporting export growth is a new Batangas plant that will double D&L's capacity by 2021. So what does this mean for you as an investor? D&L's R&D expertise, with its strategic partnerships and capacity ramp-up, will allow the company to grow their foreign accounts by its target of 10% each year. These factors will also be crucial in attracting other foreign partners aiming to expand. We believe D&L's steady domestic gains and its high growth exports to drive an overall top-line growth of 10% and a stronger EPS growth of 13%.
On to our last point, we highlight D&L's ability to deliver long-run profitability. We expect D&L's sales mix shift and operational efficiency to drive a net margin expansion of 160 bips. Historically, DNL has shown a strong track record of maintaining profitability by pursuing organic expansion while maximizing horizontal synergies. DNL has strategically diversified into related segments since starting as a specialty plastic supplier, with its most recent expansion into oleochemicals via Chemres 3 percentage points accretive to ROE. Disciplined diversification has allowed DNL to take advantage of shared production, storage, and distribution. This ability to extract synergies while expanding into high-growth markets is best seen in DNL's improving asset turnover. Moving forward, we believe DNL's low net debt-to-equity ratio of 0.2 times and strong cash flow generation ability are supportive of profitable opportunities for long-term growth. So with its improving margins, healthy gearing, and efficient turnover, we expect DNL to deliver an ROE expansion of 220 bips over the next 5 years, reflecting long-run profitability and strong shareholder returns.
In light of DNL's steady domestic gains, regional expansion strategy, and long-run profitability, we derived a 1-year target price of 13.30 pesos, presenting 50% upside from current levels. Our DCF employs a 9% WACC and 3.5% terminal growth rate. Our WACC already factors in an upward adjustment, while our terminal growth rate is based on long-run inflation in the Philippines, long-run consumption growth in the Asia-Pacific region, and the growth of specialty chemicals in mature markets. We know that 73% of our fair value is driven by its resilient domestic base and the balance from its high-growth exports platform. We also conducted a relative valuation to support our DCF, arriving at a similar target price. We compared DNL to domestic consumer names due to the lack of direct comparables in the chemicals sector, and also because of DNL's position as an indirect consumer play. For regional peers, we selected Asia-Pacific specialty chemicals manufacturers. So, at 22 times PE, DNL already trades in line with domestic consumer names. We note, however, that its PEG ratio of 1.6 times is lower than domestic peers. Versus regional peers, both PE and PEG multiples show that DNL is trading at a discount. We believe our peer analysis reveal attractive valuations for DNL given its superior earnings growth and industry-leading ROE. Our valuation methods all show attractive upside for the stock, cementing our buy recommendation.
While our buy recommendation offers 15% upside, we recognize that DNL faces inherent business risks. Today, we'll focus on 3. First, any slowdown in domestic or regional demand may harm DNL's top-line growth. However, we believe DNL's strong exposure to resilient consumer categories allows it to mitigate this risk. Our sensitivity analysis shows that exports must slow to below industry growth before our rating turns into a sell. Second, DNL faces the risk of adverse price fluctuations for coconut and palm oil, its major inputs. But we are confident that DNL can hedge against this with its pass-through pricing, where it can readjust price offerings every 30 to 45 days. And to add to this, DNL's continued shift towards customized, high-margin products will allow it to grow gross profit even with unfavorable shifts in commodity prices. Last, DNL may lose certain tax incentives upon the passage of the Trabajo Bill. But we expect DNL's expanding margins and lower regular corporate taxes to preserve medium-term profitability. Just to double-check, our scenario analysis shows that DNL will be able to maintain at least 12% earnings growth under both House and Senate versions, with upside risk should DNL apply for additional R&D exemptions. All of DNL's growth strategies and risk mitigation efforts are implemented by competent and experienced management who are committed to delivering sustainable growth and practicing good corporate governance.
Let's recap our 3 points. 1. DNL's favorable industry position that fuels steady domestic gains. 2. Its international growth strategy backed by R&D expertise. And 3. Its strong ability to deliver long-run profitability. So with a target price of 13.30 pesos, presenting 15% upside, we reiterate our buy recommendation for DNL, your local gateway to the Asia-Pacific consumption story. Thank you for listening, and we are now ready for your questions.
Thank you very much, Venus. Our panel judges, please, for your question and answer portion.
Thank you for your presentation. Noted in valuation that you mentioned that DNL already trades comparable at the same multiple as its comparables here in the Philippines. So what do you think will make the stock trade at a higher multiple? Why does it deserve to trade at a premium to its peers? And what would be the catalyst for that?
So at 22 times PE, DNL is trading in line with its consumer peers. But we do think it deserves to trade in line with its consumer peers. First, because its main clients are in the front-end markets. So previously, we showed that its clients do benefit from that consumption-driven growth, and because they are DNL's clients, DNL rides and capitalizes on the same consumption growth. But we also do think that they deserve to trade in line because they have a unique back-end position. Unlike these consumer-driven front-end clients, DNL has a unique back-end position that hedges it and it insulates it from the possible headwinds such as inflation or slowing down of consumption. And at the same time, DNL being in the back end of in the industry, it faces little to no competition against these front-end clients who are in a saturated market. DNL is the only integrated chemicals manufacturer. Possible catalysts that we do see for the stock, DNL is currently in talks with 5 additional partners, and at the same time, we also see a trend of localization. So for example, if a multinational were to come to the Philippines, DNL is in that position to be the supplier and manufacturer of choice, given its long history of partnerships with big names in the country.